Dave Weisberger is an American fintech entrepreneur and data scientist known for co-founding TradeWeb and leading CoinRoutes, a crypto trading analytics platform.
So there's two very different questions. There's the question of are there aspects of the stock market, bond market, really the derivative markets that are where being closer to the situation, you have an advantage. And so there are advantages in various places. That could be in terms of stock selection. That could be in terms of information. I mean, like obviously Congress, their insider trading and their track record just blows Warren Buffett away. So you know that they are the ultimate insider. So insider information clearly makes a market rigged if you want to look at it that way. Similarly, if Wall Street has a analyst that is going to move markets and they tell their best clients first, that could move markets. Those are the sorts of things. That's not what people talk about. What people constantly talk about is complete crap. So Michael Lewis wrote a book called Flash Boys, which everything he said was true at some point in the early to mid 2000s, but by the time he wrote the book, it was all not true. In fact, he picked somebody,
Dave Weisberger explains that there are really two separate questions when it comes to market fairness. On one hand, certain areas like stocks, bonds, and especially derivatives can reward participants who are closer to information or execution, giving them an edge in stock selection or timing. Clear examples include insider advantages, such as members of Congress outperforming even Warren Buffett, or situations where Wall Street analysts share market-moving insights with preferred clients first. However, he argues that these are not what most people focus on. Instead, public discussions often center on outdated concerns, like those raised in Flash Boys by Michael Lewis, which he says reflected real issues in the early 2000s, but were no longer accurate by the time the book was published. Dave Weisberger's main point is that markets aren't broadly rigged in the way people commonly believe. Real advantages come from insider information and preferential access, while many popular criticisms, like those in Flash Boys, are outdated or overstated.
Come in.
Well, let's be clear. Bitcoin is a potential fix to that system. Bitcoin needs some maturation to get there, and we can talk specifically. We'll put a pin in that for a heartbeat. But let's just assume that all we're talking about is the base layer of money, right? The base layer of money for a couple thousand years used to be in most places seashells. Right? People saw seashells. They were pretty. You could wear them on necklaces, but they were hard to find. It wasn't easy where they were. So it became a unit of exchange. The Indians called it wampum. It happened all over the world, right? In different places. There's other forms of money. Eventually, people realized, however, the seashells weren't very rare and you could find them much more easier than you thought. And so they wanted to come up with something else. Well, what was the next thing they came up with? They came up with precious metals, gold and silver. Gold and silver are predictably rare, relatively easy to verify one way or another, gold in particular, silver a little bit harder back in the day, but pretty easy. They were divisible, they were portable, you could use them in commerce, people understood what they were worth, and so that became a base layer. Now, why is there a need for a base layer? Well, without a base layer, the government has the incentive to spend far more than they collect in taxes, and they will spend and spend and spend, because if you're a politician, what's the easiest way to get votes? Give shit to people.
Yes.
Spending other people's money. The most common example, and it's always used, is guns and butter. That's an old expression, but it's effectively, it was swords and plowshares as well, back in the day. If you look at the history of money, one of the funny things, and I don't have coins on me right now, but if you look at a quarter or any U.S. coin, there's ridges on the side, except for the nickel and the penny, but the quarter has ridges on the side. It is a homage to the fact that Roman coins had ridges on the side. Why did Roman coins have ridges on the side? Well, because the Roman government was running out of money. And so they literally clipped the size of the coins so that they weighed less and you had to have less gold or silver in the coinage. Mm-hmm. And so governments have been trying to debase their own currency basically forever. And that's what you're seeing with regard to money. So why is Bitcoin a fix to a system? Well, in 1971 was the culmination of a move that started in 1913 with the creation of the Federal Reserve. Nixon closed the gold window. Now, he had to, because there was an idea that even though individuals could not own gold, individuals couldn't demand, other countries could. And so the U.S. had the Vietnam War and the Great Society, the first big set of welfare that was happening. And they couldn't afford it. And then given the fact they couldn't afford it, the money was leaving. And so the money was leaving the system, and he had to close the gold window. And from that point on, in 1971, the fiat era was born. From that point on, there was no longer a single currency in the world that was backed by anything fully. The U.S. claimed to have a large backing in terms of Fort Knox, but they still haven't done an audit. No one really knows what they have in Fort Knox. But even if it had everything they said they do, it's still a fraction of the total U.S. Money in circulation.
What if the biggest problem in finance is inflation itself, but the system that quietly guarantees it? You're looking at money the wrong way if you only focus on price. Zoom out and think in terms of monetary layers. As Dave Weisberger explains, every system starts with a base layer, seashells, then gold, and now fiat. Each transition happened because the previous system failed the test of scarcity or trust. Seashells lost value once supply increased, while gold worked because it was rare, divisible, and verifiable. But fiat broke that discipline. Since the Nixon shock, governments have operated without hard constraints, creating structural incentives to overspend and debase currency over time. That's not a bug. It's a feature of the system. When you understand this, inflation stops looking temporary and starts looking systemic, pushing capital into assets like stocks, real estate, and increasingly crypto. Now enter Bitcoin, not as a perfect solution yet, but as a competing base layer. Its fixed supply directly challenges the core weakness of fiat, unlimited issuance. However, the key insight here is maturity. Bitcoin still needs stronger infrastructure, usability, and broader trust before it can function as a true global base layer. So instead of asking whether Bitcoin replaces a system today, the better question is whether it incrementally absorbs trust from a system designed to dilute value. And that shift, if it continues, isn't just technological, it's monetary evolution playing out in real time. Money itself is evolving right in front of you. The real question is, will you adapt early or be forced to catch up later? Drop your thoughts in the comments. Share this with someone thinking about the future of money. And don't forget to subscribe for more deep dives. Dave Weisberger's main point is that throughout history, money systems fail when they lose scarcity and discipline. And since fiat currencies allow unlimited government spending, Bitcoin's fixed supply offers potential alternative, but it still needs time to mature before becoming a true base layer of money.
The thing that Bitcoiners look at is they say, well, listen, the gold standard failed because the gold standard is gold just really doesn't work in a modern digital economy. And I don't want to hear the notion, well, you can tokenize gold. It's like, sure, but you still got to trust men with guns guarding it.
Exactly, yes.
And you still have to trust the fact that it's real, that it hasn't been counterfeited. And you still have to be able to move it, store it, et cetera, verify it. Those are things you cannot do with very easily. And in fact, it doesn't scale very well. Bitcoin does. Now, we could debate whether or not you could have credit layered on top of Bitcoin or gold. And I come down pretty firmly on the point of, yes, you should be able to do that for a lot of reasons in terms of monetary business cycles and lots of stuff. Caitlin Long likes to call me Murray Rothbard or Rothbardian, because I believe in that. That's fine. I'll take it. I think he was a fairly smart dude. But the fact that Bitcoin has that ability, if it gains a critical mass of acceptance, makes it singularly unique among assets. And so that's why I am into it. But that's the answer to your question. Now, if you want to understand what happened in 2008, it was a dramatic underpricing of the real risk. So people started to figure this shit out and would take deals that they didn't like, and they would price it super aggressively to the point where they made no sense, confident in the fact the Citi would swoop in and outprice them and take that crap on their balance sheet, which is why in 2008, Citi was undeniably bankrupt. Completely bankrupt, bailed out by the government in a variety of ways. Never went under because they were bailed out, but they were way underwater in all their investments. So because of this, but anyway, there are these two. The core of 2008 was underpricing risk.
Yeah.
In Bitcoin, that never happens. Even in the case where people take out loans to get Bitcoin, they get liquidated if they took it out. If they took out too much risk, the market's brutal. If you take a 50% loan to value on Bitcoin and you took it out at 126, you got liquidated. In fact, at a certain point, the notion of HODL at the extreme would damn Bitcoin to failure. Now, that said, as a smart investor, if you think something is 95% undervalued, selling it is stupid. And so therefore, you get to the second problem, which is right now, Bitcoin is taxed in most jurisdictions such that if you sell it and then buy more, you have to pay capital gains on what you sold. So that's true in the US. So now take me. I have N number of Bitcoin. It's not a huge amount, but it's enough that, I'm a whole coiner. I'll say that much. But not, I'm not Grant Cardone. I'm not selling houses. I'm not, whatever. Why would I sell even a Satoshi when I have to pay capital gains taxes for my cost basis under 10,000? The answer is I wouldn't. It would be stupid to do so because I would have to pay all of that. So until there's a way to spend Bitcoin, it's not without capital gains implications, it won't get used as currency. My bet is it won't happen until such a time as it's done going up. Or, so Bitcoin therefore won't become a currency, but be an investment until it gets to some equilibrium somewhere at today's prices around, with gold where it is, at around 1.4 million. At which point, then it could be used because then anything is probably just moving with the money supply. It could still go up, but it's not necessarily just going up because it's undervalued at that point. So you have to understand those are two very important dynamics.
Imagine a form of money that can be inflated, can be confiscated, and enforces risk automatically. Welcome to the world of Bitcoin. If you analyze this discussion through a modern financial lens, you'll notice Bitcoin is being framed not just as an asset, but as a structural upgrade to legacy monetary systems. The comparison to gold highlights a key limitation. Physical assets rely on trust layers, custody, verification, and transport, which become inefficient in a digital economy. Bitcoin, by contrast, scales through code and network consensus, eliminating many of those friction points. More importantly, the 2008 financial crisis is used as a benchmark for systemic failure, where risk was mispriced and ultimately socialized through bailouts. In Bitcoin markets, however, risk is enforced in real time through liquidation mechanisms, meaning excess leverage is punished instantly rather than deferred. That creates a harsher but more transparent system. At the same time, you can see a critical adoption barrier emerge: taxation. In jurisdictions like the United States, capital gains rules discourage spending, reinforcing Bitcoin's role as a store of value rather than a medium of exchange. This leads to a transitional phase where Bitcoin behaves more like digital gold, potentially until it reaches price equilibrium. Only then does the incentive structure begin to shift toward everyday currency use. As adoption grows, Bitcoin's unique combination of scarcity, transparency, and algorithmic enforcement of risk positions it as a revolutionary financial instrument. You can observe that unlike traditional assets, it operates without reliance on centralized authorities or custodial trust, reducing systemic vulnerabilities. Yet, structural barriers remain. Capital gains taxation and usability hurdles keep it anchored as a store of value rather than a circulating currency. This dynamic suggests a two-phase evolution. First, accumulation and wealth preservation, and later, practical transactional use once price stability and regulatory clarity align. Monitoring these factors is critical, as they define both short-term market behavior and long-term macroeconomic implications. Bitcoin's trajectory challenges conventional finance, forcing reconsideration of risk, liquidity, and monetary policy in the digital age, and signals that those who understand these mechanisms are better positioned to navigate the emerging crypto economy. Bitcoin is reshaping the future of money. If this insight sparked your curiosity, drop a comment, share this with your network, and don't forget to subscribe for more crypto analysis. Do you think Bitcoin will replace gold as the ultimate store of value, or will it remain a digital investment asset?